In this video, we're going to explore 4 reasons why Disney stock is a hold today. Before we begin, I invite you to subscribe to this channel and like this video, which will help more people discover Dividend's investor education efforts. With that out of the way, let's dig into 4 reasons why Disney is a hold today. First, let's talk about Disney's business model. Disney is a diversified entertainment conglomerate that operates in different industries, including media networks, primarily ESPN, parks and resorts, with assets such as Disneyland and Disneyworld, studio entertainment, with franchises such as the Marvel Universe and Star Wars, and consumer products. Disney was founded by Walt Disney and his brother Roy in 1923, and has since grown into a blue-chip company valued at about $240 billion. Despite its immense size and long-term track record of strong total returns, fueled by years of rising dividend payments and stock price appreciation, Disney's total return outlook still remains reasonable today given the generally low risks facing the company. That being said, they are not attractive enough to make us want to buy the stock right now. In the remainder of this video, we are going to look at the 4 reasons why we believe this to be so. First and foremost, Disney's business model possesses the durable competitive advantages necessary to continue generating attractive returns on invested capital while fending off growing competition in the video entertainment space. The main driver behind this conviction is the strong pricing power their networks and Disney-branded products have enjoyed despite growing competition over the past decade. By adding on 21st Century Fox to the mix, this brand-driven pricing power should only increase. Another competitive advantage that we believe will drive Disney's long-term outperformance is its vast, pre-existing library of media content that already has a broad, strong, and loyal following among the general population. Franchises such as the Disney Princess Collection, Star Wars, and Pixar movies are deeply embedded in American culture, and will therefore very likely have staying power for generations to come. This will give Disney numerous opportunities to remake these films as well as add sequels, prequels, and related films or TV shows to generate large sums of revenue at fairly low risk. Disney's strong position in sports television is another competitive advantage that will likely last for the foreseeable future. Its ownership of ESPN, the dominant player in the US sports entertainment industry, gives it unmatched brand and network strength, which it can leverage to charge higher subscriber fees and generate outsized profits. Disney also owns one of the top 4 US national broadcast networks in ABC, along with its affiliated stations in 8 markets, 6 of which are in the top 10 markets nationwide. While the popularity of mainstream media is declining, each of these networks remains widely used throughout the country and will likely remain a major source of steady revenue for the company for the foreseeable future due to their dominant positioning within the industry. The Disney Channel is one of only 2 popular cable networks for children, giving it another attractive form of revenue. Meanwhile, its Fox acquisition combines with its Disney Channel to create a very strong studio television presence. Finally, the company's ownership of Hulu and announced launch of Disney Plus synergizes all of these previous competitive advantages into a packaged service that will contribute meaningfully to the company's revenue growth over the long term. The pricing power enjoyed by its media products will enable them to compete very effectively with Netflix, Amazon, Apple, and others competing in the media subscription space. Furthermore, their large library of content ranging from movies to studio television programming to sports to news gives them a massive library that will enable them to hit the ground running with Disney Plus and turn it overnight into a formidable force in the space without having to invest much additional capital into initial new content production. The company also plans on bolstering its Hulu initiative through a recent agreement with Comcast to partner in the business. The second reason we think Disney has a low long-term risk outlook is because its balance sheet is far superior to that of Netflix, its primary competitor to its new Disney Plus business. With an A credit rating from S&P and Moody's, strong free cash flow generation, and a small 0.42 debt-to-equity ratio, Disney is in great shape to self-fund investments in content production without needing to access debt or capital markets. This will enable it to sustain its competitive advantages much more easily than Netflix, since Netflix has a junk credit rating, is rapidly bleeding cash, and has a very sizable 1.81 debt-to-equity ratio. As a result, Netflix is forced to regularly access debt and equity markets to continue financing its investments in new content production. Once Disney pulls its content from Netflix will be more pressed than ever to generate new content to compete with Disney. If the stock market hits a downturn and or credit markets tighten, Netflix will be caught in a bind and Disney will be able to further strengthen its position relative to its closest competitor. The third reason we think Disney's long-term returns will be reasonable relative to its low risk is because it has a strong growth profile. Disney already has strong earnings growth record, as over the past decade its earnings per share have grown by 17% annually. Disney's profitability is somewhat cyclical, as its studio entertainment division shows widely ranging profits depending on its movie lineup in each individual quarter. Overall, however, Disney's different businesses are all showcasing solid long-term growth, with the exception of its media networks business. Cord cutting is hurting revenues and profits in that segment. During the second quarter, results from this segment were flat year over year, which is better than the declines that Disney had to report during some quarters throughout the last couple of years. Earnings per share growth has also been boosted by share repurchases in the past. Management has stated that this may slow in the near future as the company will focus on bringing down debt levels after the acquisition of 21st Century Fox's assets. The acquisition of Fox's assets will be accretive to Disney's earnings immediately, and the full impact of that should be visible in the third quarter and beyond. With the integration of the acquired intellectual property into Disney's existing theme parks and other sales channels, Disney will most likely see a boost to all of its segments. Looking ahead, the parks and resorts business is riding a strong wave of momentum from its strong revival since the last recession, and the opening of Disneyland Shanghai could serve as a substantial new tailwind. The company's movie franchise remains as profitable and popular as ever, as evidenced by its massive box office hauls. Disney's films brought in $7 billion at the box office last year alone on the strength of 900 million tickets sold at theaters worldwide. The Avengers Infinity War film alone sold 290 million tickets globally earlier this year. Disney and Pixar films also remain highly popular, averaging $690 million per film at the box office since 2006. Marvel films have averaged nearly $1 billion at the box office over the past decade, and the 4 latest Star Wars films have averaged $1.2 billion at the box office. Overall, since 2006, Disney-owned films have generated an average of $850 million per film for a total of over $37 billion of revenue over that time span. Of course, the biggest growth driver should be the combination of Hulu and soon-to-be-launched Disney+, which should tap into the rapid growth market enjoyed thus far by rivals Netflix and Amazon. Already, Hulu is the fastest-growing video service in the United States, adding 8 million new users in 2018 alone. Customers are also spending more time on Hulu, with 75% growth in total engagement and a 20% increase in time spent per day in 2018. Disney Plus, meanwhile, has big plans to combine franchises like Disney, Pixar, Marvel, Star Wars, and National Geographic to dominate market share across all age and gender spectrums. Already in the top 12 media markets in the world, Disney enjoys 95% brand awareness and over 1 billion avid fans. The goal is to reach 100 million households and continue growing from there. At about $60 per year for a subscription, if Disney can achieve this goal, it will be generating enormous profit margins and around $6 billion in additional revenue per year. Meanwhile, ESPN remains the king of sports television. It reaches approximately 200 million people per month in the United States and has been the #1 top-rated cable TV network among men for 13 years in a row. Despite its large presence, it is still experiencing vibrant growth, seeing 18% unique visitor and 29% total time spent growth year over year. Finally, Disney views India as a promising geographic venue for achieving strong growth in the years to come. Since 2006, the country's GDP has achieved an 8% growth rate and has over 600 million people under 25 years old, which is a prime audience for Disney's products. Meanwhile, the Indian middle class has been growing at double digits each year for the past decade and is expected to continue doing so for the next decade at least. With this rising wealth is a rapid growth in the number of video screens in the country and demand for video entertainment. As a result, the company's Hotstar business plans to achieve impressive growth as it provides extensive coverage of the country's most popular movies and sports, such as cricket. Another aspect that should fuel growth is that as each of its businesses continues to thrive and increase their dominance in their respective spheres, the ability to synergize and feed into each other's growth and competitive positioning also increases. Of course, no business is risk-free, so investors need to keep in mind the following risks. First, while its Disney Plus business looks very promising, the field will be saturated with competition soon. In addition to Netflix, which already has a running head start in the space, there are tech powerhouses Amazon and Apple also joining the space. It would be a huge mistake to underestimate these two, given the resources they bring to the table. The business is also a major cash burner. While Disney has the advantage of significant pre-existing content, it will still struggle to be profitable immediately. Second, mainstream media continues to decline, and the sports broadcasting industry also faces competitive threats from tech companies. As a result, both of those businesses could very likely face weakening pricing power and/or declining revenues and market share in the near future. Additionally, as professional athlete pay continues to rise, the cost of sports broadcasting contracts may skyrocket, which could significantly eat into Disney's profit margins in this space. Finally, the company's theme parks have proven to be highly cyclical. If the next downturn hits sooner rather than later, we can expect a noticeable hit to earnings from this business segment as well. This feeds into our fourth and final reason why Disney is a hold rather than a buy or a sell today. Its valuation is not outrageous, but certainly not compelling given its business fundamentals. The company's shares trade for about 17.5 times this year's expected earnings. While this is not a high valuation in absolute terms, it does represent a higher valuation compared to how Disney's shares were valued during 2018, and also compared to what we deem a fair valuation. We think a more reasonable earnings multiple for the company given its history and growth prospects is around 16.5 times annual net profits. With a dividend yield of 1.3% and 7% annual growth expected, total returns before adjusting for earnings multiple contraction are a solid but unimpressive 8.3%. Factoring in a 120 basis point total return headwind from multiple contraction, and we get expected annual total returns of 7.2%. To summarize, we believe that Disney offers investors a very stable business model thanks to its numerous and compelling competitive advantages. With a strong balance sheet, a well-covered and growing dividend, and several avenues for continued growth, there is every reason to believe that Disney will provide solid returns for years to come. However, given the fact that its dividend plus expected growth total return proposition is fairly lackluster, and the price to earnings multiple is on the higher end of the spectrum, we cannot recommend it as a buy at current prices. Because of this, the company earns a hold recommendation from Dividend today. Thank you for watching today's video, which explained 4 reasons why Disney stock is a hold at current prices. We invite you to subscribe to this channel and like this video, which will help more people discover Dividend's investor education efforts. If you're interested in learning more about our systematic approach to dividend growth investing, visit our website at www.suredividend.com.